All right, let's dive right into this explainer and look at the massive tension right now between Amazon's explosive AWS growth and its totally unprecedented AI spending. We're looking at a company that is essentially at a historic crossroads. Is this a growth machine firing on absolutely all cylinders, or are they burning through so much capital that investors are going to be left waiting years to see actual returns? Well, we're going to break down exactly what these numbers mean for your portfolio. But before we really unpack the story, let's just ground ourselves with Amazon's sheer scale today. We're talking about a massive $2.87 trillion market cap, with shares trading right around $266. But notice that average price target, $322.56. That implies a really bullish 21% upside from analysts, who currently give it a moderate buy rating. But those numbers only tell the very beginning of the story. To give you a clear, totally objective look at the stock's risk-reward profile, we're going to follow this roadmap. The $3 trillion juggernaut, AWS and the AI boom, the $220 billion dilemma, valuation and insider selling, risks to watch, and finally, the final verdict.
Okay, Section 1, the $3 trillion juggernaut.
What's truly staggering here is that despite already being this nearly $3 trillion behemoth, Amazon is still delivering explosive top-line numbers. I mean, they just crossed $200 billion in a single quarter for the very first time, hitting $200.61 billion in Q2. Delivering that kind of growth at this massive scale is honestly exceptional. But to understand where that momentum is really coming from, we've got to look under the hood.
That brings us to Section 2, AWS and the AI boom.
Analyst sentiment is incredibly strong right now. It's brilliantly captured by Morgan Stanley, who literally called AWS the most underappreciated asset in tech. In fact, they slapped a massive $500 price target on the stock, largely because of AWS. And Goldman Sachs, they're highly optimistic too, raising their target to $375 after these recent Q2 earnings. And the data completely backs up that optimism. AWS revenue grew an astonishing 37% year over year to $42.2 billion. Guys, that is the fastest growth they've seen in 18 quarters. A massive driver here is their AI workloads, which are now generating revenue at a staggering pace of $25 billion a year. Management genuinely believes AWS can become $1 trillion annual business. Why? Because it's a classic land and expand strategy. Once enterprises lock their AI workloads into the AWS ecosystem, the switching costs are absolutely massive.
Moving on to Section 3, the $220 billion dilemma. And this is the absolute core tension of this entire explainer.
On one hand, AWS is an absolute cash-printing machine. It generated an extraordinarily profitable $16.6 billion in operating income in Q2 alone. That gives Amazon this incredible war chest to just fund its future ambitions.
But then you look at this number. Amazon is planning to spend $220 billion this year on capital expenditures. That is more than the GDP of many entire countries, and virtually all of that is going straight into AI, data centers, and infrastructure.
So here's the catch. This unprecedented spending is completely draining the actual cash the business generates. It's pushed Amazon's free cash flow straight into negative territory. Now, while Amazon has successfully spent heavily before on things like fulfillment centers and Prime Video, this scale is totally new. It's making investors wonder just how long they're going to have to wait for a return on this AI mega investment.
Actually, if we look even closer, the current earnings picture isn't quite as rosy as it seems at first glance. A really significant chunk of that recent profit actually came from a one-time non-cash gain related to their investment in the AI company Anthropic. It didn't come purely from their core operations. And this is where the bear case really starts to build momentum. Despite basically betting the farm on AI and spending hundreds of billions, AWS is still growing slower than Microsoft Azure, which is currently posting 43% growth. Google Cloud is also gaining market share. In a market that a lot of people see as winner-take-all, Amazon is paying a premium just to stay in the race.
Next up, Section 4, Valuation and Insider Selling. We need to see what the people inside the company are actually doing with their own money. If we track insider activity over the past 12 months, a pretty glaring trend emerges. There have been exactly 0 insider purchases, none. Meanwhile, insiders have sold $459.7 million worth of shares. And in early August, Jeff Bezos alone sold roughly $4 billion in stock. Now, sure, some of this is absolutely for prearranged tax diversification. But the complete absence of any insider buying over the last year, that is a stark data point you simply cannot ignore.
From a valuation standpoint, if we look at Guru Focus's intrinsic value metric, which calculates what the core business is fundamentally worth, the stock's true value sits around $246 per share. With the stock trading around $266, that means it's roughly 8% overvalued right now. You're currently paying a premium for future growth, meaning Amazon has to grow into this valuation fast, or the stock could face some real pressure.
Section 5. Risks to watch.
Outside of the balance sheet, there are real-world headwinds we have to factor in. First, regulatory hurdles are popping up everywhere, like new data center standards in states like Pennsylvania that could slow expansion and drive up costs. Second, we're seeing consumer weakness. U.S. retail sales actually declined 0.6% in July, threatening their core e-commerce engine. Third, competition is just fierce, which threatens margin compression if a pricing war breaks out in the cloud space. Oh, and plus, they're facing this bizarre PR nightmare over reportedly destroying Ware books just to scan them for AI training.
Finally, Section 6. The final verdict. So, what does this whole tug-of-war actually mean for you?
Side by side, it's incredibly clear. The bull case sees AWS as a once-in-a-generation asset with 30 to 40% annual growth ahead as AI workloads explode. But the bear case? They point to the staggering $220 billion in spending, negative free cash flow, and fierce competition. Ultimately, Amazon is a high-conviction, long-term growth play for those who can stomach the volatility and dollar-cost average over 3 to 5 years. But short-term traders? You risk a 15 to 20% correction if these massive AI returns are delayed even a little bit.
Ultimately, it really all comes down to this single, pivotal question. Do you believe Amazon's massive AI gamble will pay off and transform enterprise computing in time? Or is it $220 billion price tag simply too high for investors to wait on? It is literally the most important question in tech right now, and one every investor needs to answer for themselves. Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.